Hey guys, welcome back to my channel. Today I'm going to present the three major investor profiles to help you determine which one you are. So before you start investing in stocks, it's very important that you determine your investor profile and that you know exactly what your objectives are. Once you know what your objectives are for your investments, this will help you determine your investment strategy, and you will know which products to buy, how much of each product to buy, and over what time horizon you will hold on to these products for. So let's get right into it. To determine your investor profile, you have to answer a series of questions relating to your personal situation, your risk tolerance, and your investment horizon. So if you go see a financial advisor, they will ask you a series of questions such as your age, how old are you? Because generally somebody who is younger will have a higher tolerance for risk than somebody who is older, who will be looking to preserve their capital and hedge against inflation and generate some type of income to supplement their retirement. Then they will ask you, what is your personal situation? Are you single? Are you married with kids? Are you married without kids? So generally, a single person will be able to take on more risk, of course, because they have a longer investment horizon, so they have more time to see out a strategy. And also, if they lose some money, they also have a lot of years ahead of them to catch up this money, make this money back. Whereas somebody who is married with children will have to have a much lower risk portfolio to make sure they don't lose much of their capital because they will have a lot of expenses. Then they will ask you, what are your objectives? Why exactly are you investing? Are you investing to buy a house? Are you investing to save up for retirement? Are you investing to help finance your kids' studies? Are you investing to achieve financial independence? So what is your investment objective? And in function of each of these objectives, you will be recommended to buy different products. And this ties in also to your investment horizon. How long are you investing for? When will you need this money? Because the shorter of a time frame that you invest for, the safer your investments should be technically, because you have less time to see out a riskier strategy. And if you were to lose money through this risky strategy, you would have no time at all to make this money up. So if you're saving to buy a house, you also don't want to take too many risks with this capital that you need, that you've saved up for, that you need for a very important purchase. You want to make sure you place it somewhere safe where it will grow at a reasonable rate. And then when you're ready to buy that house, that money is there and you haven't lost 35% of your principal in some risky investments. Then you have to ask yourself, what is my tolerance for risk? And this is one of the most important aspects when you start investing, is asking yourself, how much risk can you tolerate? Because as a general rule of thumb, in the stock markets, the more risk you are willing to take on, the more potential returns you can generate. Whereas the lower risk you're willing to take on, the lower returns you can expect. So investors are always struggling between these two extremes of extreme risk, extreme reward, or low risk, low reward. And again, your choice will depend on whether the possibility of losing your investment will keep you up at night, but also on your age, your income, your investment horizon, and your investment objectives. So these are the first questions you have to ask yourself before you invest a single penny in any investment product at all. So now let's take a look at the three most common investor profiles. The most common investor profile is the conservative investor. This is an investor who has zero tolerance for risk. He wants safe returns, zero risk. He doesn't want to stay up at night knowing that his investment has gone down. So there's a few different cases of who this investor can be. It can be a total novice who's entering the markets for the first time and he just wants to kind of understand what's going on and just kind of place his money and kind of treat the stock market as a safe savings account where he can get slightly better returns than on a traditional savings account. Or it can be somebody else close to retirement who has quite a lot of capital on hand already and just wants to protect this capital against inflation, maybe generate some type of income from this capital. So they will also favor much safer investments. And so the type of investments that you can have here, so obviously you can have high interest savings accounts, you can keep a portion of your cash there. Then you can invest obviously in stuff like bonds or ETFs, certain ETFs that are specialized in bonds, or S&P 500 ETF or some dividend aristocrat ETFs. So if you don't know what dividend aristocrats are, a dividend aristocrat is a company, so generally these are huge multinational conglomerates who have paid out dividends for a long time, but who have the particular notable track record of increasing their dividend at least once a year for the past 50 years or more. So this is actually what I'm describing here, dividend kings. Dividend aristocrats have raised their dividends at least once over the past 25 years. So these are dividend aristocrats, very safe companies who perform well even when there's major crises going on. Then there's even dividend kings who have raised their dividends for the past at least once a year for the past 50 years. So for example, Coca-Cola is one of these companies, or Johnson & Johnson, who have raised their dividends, Johnson & Johnson, for almost the past 50 years. So these are the type of companies that a conservative investor will invest in to make sure that his money is in a safe place and he will not lose any of his capital. So generally, people who are novices or older people reaching retirement age, or married couples with children who want to kind of protect their savings, should favor a conservative investment approach. The second most common investor profile is the balanced investor. So this is an investor who will strike a balance between tolerance for risk and the will to have safe investments. So balanced investors actually are the majority of investors out there who kind of want passive investments through ETFs, so S&P 500 ETFs, and they also want to have a little bit of active investment going on, so they will invest in some individual companies that they analyze. So these people who are balanced investors are generally between the ages, let's say, of 25 to 45. They know a little bit about how the market works. They know how to scour the markets for undervalued companies. They kind of know how to analyze companies a little bit, and they like to buy low, sell high. So they will have a part of them that will kind of do some form of, maybe not trading, but at least short-term positioning, So they'll buy a stock, hold on to it for a few months, and then sell it when it reaches a certain peak, and then use this money to reinvest it in other undervalued stocks. But for the most part, the majority of their portfolio will be placed in S&P 500 ETFs or NASDAQ ETFs, or some type of investment fund or mutual fund that will allow them to grow their money relatively safely. And then a small part of their portfolio will be allocated towards these riskier assets. So this is the type of approach I think most people should adopt, okay, because it's relatively quite safe, and then you can also determine what percentage you allocate towards these riskier investments. But for the most part, this is quite a safe strategy, and I think this is the one that most people should implement once they get comfortable with investing in stocks. Then the last investor profile is the aggressive investor. So as the name suggests, an aggressive investor is somebody who likes to take risk and multiply his capital. So this is somebody generally who's a sophisticated investor, who has a lot of experience in the markets. He knows how the market works, how market psychology. He has good capital risk management. He has good self-control. He knows how to analyze trends. He knows what the importance of volume and volatility, and the psychology of crowds, how the market reacts a little bit. So he's the kind of person who buys when people are fearful, and he's fearful when people are greedy. He knows kind of more or less how to time the market, because it's something that's very difficult to do. But let's say with his years of experience, he kind of has some stocks he's familiar with, and he likes to trade them. And he likes to invest in, let's say, obscure small cap companies like small pharmaceutical stocks or up and coming tech stocks that could be the next big thing. And he's willing to take risk. I mean, a lot of the times these bets go wrong and they can lose 40-50% of their capital because they place it on a bad company. Other times they can multiply their capital 8, 10, 12, 15 times. The sky's the limit sometimes. If you enter a small company that just went public, and you bought their stock for a few dollars, and 5-10 years later the stock reaches $500 a share, well, you've basically created a lot of wealth. But it's very rare that this happens, and you really have to take a lot of risk. But again, a lot of the risk that these aggressive investors are taking is calculated risk. They've studied for hours what these companies do. They've analyzed their future projections. They're analyzing cash flow. They're analyzing, is the management team innovative? Are they serious? What segment are they operating in? And is this segment part of a secular growth trend that will actually generate wealth in the years to come, or is this a declining sector? So this is actually an investment strategy that takes a lot of work. And also keep in mind, you have to have time dedicated to be able to buy and sell the stocks at the right time, which not everybody can do, because if you have a full-time job, you can't be glued to your computer screen all the time. Also, generally, these are people who have above average income because they are willing to risk part of their capital, knowing that they have a safety net that they can fall back on, which maybe is other savings. They have savings that they can also save and invest at the same time. So these aggressive investors are not your ordinary run-of-the-mill investors, and in fact, beginners should not adopt an aggressive strategy because they don't know enough about the markets and they don't have the discipline. So keep in mind that aggressive investing is something, if you want to become an aggressive investor, you have to just do your time and be patient. Okay, over the years that you gain experience, you will get towards that step. But most beginners should definitely stick to a more balanced investment approach of having the majority of their funds in a passive investment vehicle, such as an ETF, And then they can maybe place 5-10% of their capital and start buying riskier stocks, stocks that they analyze themselves. Take a little gamble, it doesn't hurt to do that if you kind of know what you're doing. But again, you have to make sure it's only a small part of your portfolio, because this is hard-earned money you're investing and you don't want to throw it out the window. There's a lot of scams out there these days. There's a lot of websites with a lot of trolls telling you invest in this stock, but they're just pumping it. And once you buy in, you're buying it at the top and they're dumping their bag on you, and you're left holding a lot of worthless stock that may never appreciate in value again. And all that money you lost, that's hours of labor. Or if you're a businessman, that's also hours of work you put in to generate this wealth that you've got. And you want to make sure you protect that at all costs. So the most important thing to do, in my opinion at least, is to invest in passive investment vehicles such as ETFs. Make sure you go for safety first, and then as you get experience and knowledge, you can start adventuring yourself into more of an active investment approach, but it's not something you should be doing right off the bat. So thank you for watching this video. I hope you appreciated it. I hope it helped you kind of understand what the different investment approaches are. My next video will be about, I will present different financial products based on their level of risk. So it'll help you know which products you should target based on your tolerance for risk and your investment profile. So I hope you will be looking forward to that. I know I am. I'm preparing it. I'll be filming it soon. So leave a like under this video, please, to help me beat the YouTube algorithm. Don't forget to subscribe to be notified of future publications. Leave a comment below to start a conversation. Let me know what you guys think. As always, underneath in the description of this video, you can read the article on my blog that explains this. That's basically the transcript of this video. You can read the same article on my French blog, Liberté Finance. You can also check out my French YouTube channel. All that good stuff is in the description. So thank you guys for listening, and I'll see you next time. Happy investing.